HighBridge, a division of Recorded Books, presents Financial Literacy, Implications for Retirement Security and the Financial Marketplace, edited by Olivia S. Mitchell and Annamaria Lusardi, read by Kitty Hendrix. Preface. In the wake of the global financial crisis and the ensuing recession, a wide variety of stakeholders, households, plan sponsors, financial service firms, and governments, is now searching for more effective ways to manage financial risk. Nowhere is this more important than in the arena of planning and saving for retirement, where widespread evidence of financial illiteracy is spurring a rich variety of new projects on how to best enhance financial knowledge and tools for decision-making. Accordingly, we are proud to present our newest Pension Research Council Boatner Center volume, exploring lessons for financial literacy in the wake of the crisis, as we work to identify how to help decision-makers in making more informed economic choices. In the process of preparing this book, several key people and institutions played essential roles. Excellent editorial help was provided by my co-editor, Annamaria Lusardi, a valued colleague in financial literacy research. On behalf of the Council, I thank her, along with all the contributors to the book, the reviewers who helped bring this work to fruition, and the Council's advisory board on whom we rely for guidance. A key supporter of important research and development in the U.S. financial literacy arena is the Social Security Administration's Financial Literacy Research Center, with which both Lusardi and I worked closely. We are also grateful for the intellectual and financial sustenance provided by our senior partners and the institutional members of the Pension Research Council, listed elsewhere in this volume. The Wharton School graciously provided access to conference facilities and more through its Impact Conference funding. Additional financial support was received from the Pension Research Council, the Boatner Center for Pensions and Retirement Research, and the Ralph H. Blanchard Memorial Endowment at the Wharton School of the University of Pennsylvania. We also offer our appreciation to Oxford University Press, who hosts the Pension Research Council series of books on retirement security. This book was expertly prepared and carefully edited by Matthew Rosen with assistance from Andrew Gallagher. Our work at the Pension Research Council and the Boatner Center for Pensions and Retirement Security of the Wharton School of the University of Pennsylvania has focused on aspects of pensions and retirement well-being for over half a century. This fine volume will be a welcome addition to all concerned with the future of financial literacy and retirement security. Olivia S. Mitchell, Executive Director, Pension Research Council. Director, Boatner Center for Pensions and Retirement Research, the Wharton School, University of Pennsylvania. Chapter 1. The Outlook for Financial Literacy. Annamaria Lusardi and Olivia S. Mitchell. As financial markets grow more complex and integrated, individuals and their families are increasingly faced with making highly sophisticated and all too often irreversible economic decisions. Nowhere is this more evident than with regard to retirement decision-making. A half-century ago, traditional defined benefit DB pension schemes were the norm in the United States, Japan, Australia, and much of Europe. But these have now been largely replaced with defined contribution DC pensions. In the process, employer and government judgment regarding how much to save and where to invest has been replaced by individuals having to make these choices on their own. Perhaps assisted by advisors they also select on their own. Additionally, participants in DC plans must also decide how to spend down their pension assets and determine whether to annuitize or take their benefits in a single lump sum. The trend toward increased individual responsibility and greater financial complexity extends into other realms of life as well. For example, regarding decisions over credit cards, adjustable rate mortgages, and when to claim retirement benefits. Moreover, given the demographic forces at work and the structure of the labor markets, where workers change jobs and employers many times before retiring. The increase in individual responsibility with regard to financial security after retirement will continue to be a feature of many economies around the world. A larger array of sophisticated financial instruments does offer new opportunities for more tailored financial plans than available in the past. But these can also make poor decision-making more costly to the ill-informed investors. Indeed, recent events surrounding the global crisis that began in 2008 show that when people and institutions make grievous financial errors, poor financial decision-making can have substantial costs, not only for individuals, but also for society at large. This volume focuses on key lessons for financial decision-making in the wake of that crisis, exploring how financial literacy can enhance people's skills and abilities to make more informed economic choices. The chapters that follow draw on cutting-edge research by prominent researchers and practitioners engaged in examining how financial knowledge can shape cost-effective financial planning and behavior. The research reported in the volume suggests several main findings. First, financial literacy determines how well people make and execute financial decisions, including saving, investing, borrowing from one's retirement account, and planning for retirement. Second, new evidence is reported on the extent of financial knowledge, or lack thereof, drawing from several surveys. Financial literacy's effects on financial decision-making extend above and beyond the effects of education, sex, race, income, and other factors previously found to be associated with gaps in financial knowledge. Third, researchers acknowledge and address directly the all-important casual question, namely whether financial literacy drives saving and wealth accumulation, or whether the causal mechanism is the reverse, from wealth to financial literacy. For instance, people might invest in financial knowledge, so they then learn about complex assets, in which case the positive association of literacy and wealth would not imply that knowledge causes investing. But conversely, lack of knowledge might prevent people from investing, or, alternatively, those with no money may fail to learn about financial markets. Accordingly, several of the researchers represented in this volume develop controlled settings in which they try to disentangle these causal links. And this work shows, we believe, quite convincingly, that financial education programs do indeed enhance financial decision-making and asset accumulation. The work presented in this volume will be of interest not only to researchers and teachers, but also to policymakers from all over the world engaged in financial reforms in the wake of the financial crisis, as well as providers of financial advice and financial services. Global awareness is growing on the need to improve retirement security via increasing financial literacy. For instance, the U.S. President's Advisory Council on Financial Literacy noted that, while the crisis has many causes, it is undeniable that financial illiteracy is one of the root causes. Sadly, far too many Americans do not have the basic financial skills necessary to develop and maintain a budget, to understand credit, to understand investment vehicles, or to take advantage of our banking system. It is essential to provide basic financial education that allows people to better navigate an economic crisis such as this one. Many other groups concur, including the Organization for Economic Cooperation and Development in Europe, a leader in recognizing the importance of financial literacy, which recently announced a major initiative to identify individuals who are most in need of financial education and the best ways to improve that education. The Reserve Bank of India, which launched an initiative to establish financial counseling centers throughout the country, and the Russian Federation, which is implementing with the World Bank a major initiative to build consumer financial sophistication. Countries covered in this volume, such as New Zealand, had also undertaken major initiatives to address the problem of financial illiteracy. These initiatives, developed after collecting thorough information on the financial capability of individuals in those countries, offer important suggestions in other countries as well. The research presented in this volume can also be helpful to those seeking ways to help individuals and their families as they embark gingerly into the modern financial system, sometimes after substantial missteps. In what follows, we briefly outline themes and highlight salient lessons. Financial literacy and financial decision-making. In our prior work, as well as this volume, we examine how many different groups understand basic financial concepts and plan for retirement. Our chapter in this volume explores how older Americans make financial plans, collect the information needed to make these plans, and implement the plans. Moreover, we show how financial literacy affects retirement planning. We show that financial illiteracy is widespread, particularly when it comes to understanding calculations related to interest rates and the effects of inflation, along with the more nuanced concept of risk diversification. Only half of all respondents in the survey can correctly answer two simple questions regarding interest rates and inflation, and only 1/3 correctly answer these two questions, plus a question on risk diversification. Financial illiteracy is widespread among older Americans, but shortfalls are particularly concentrated among women, minorities, and the least educated. Furthermore, the financially savvy are more likely to plan and to succeed in their planning, and they tend to rely on formal methods such as retirement calculators, retirement seminars, and financial experts, instead of family, relatives, or coworkers. We argue that targeted financial education efforts are likely to be most effective in filling these knowledge gaps. The workplace is an important source of financial education, particularly as workers approach retirement. In a study by Robert L. Clark et al., the authors investigate the role of employer-sponsored retirement planning sessions in shaping retirement planning. Drawing on case studies, they examine seminars offered to individuals with mandatory DB plans and voluntary DC plans. In these seminars, employees learn about retirement planning as well as details of their own benefits and pension distribution rules. To see how the seminars work, participants are asked about their retirement intentions prior to and after the sessions, to determine whether the seminar is associated with any change in retirement intentions and plans. The authors conclude that 1/3 of those who originally indicated they would probably take the DB lump sum payment before the seminar decided afterwards not to take that option. Of those who originally planned not to take the lump sum, almost half changed their minds post-seminar. As for annuitizing DC plans, almost half changed their plans and decided not to annuitize following the information session, compared to 1/5 who decided to annuitize after learning more about their retirement options. Those who indicated they would take the lump sum tend to have more knowledge about retirement-related finance. In this sense, many people who indicated that they would not take the lump sum distribution actually did not know they had that option prior to the seminar. The survey also reflects only stated intentions rather than actual behavior. But when it comes time to actually make a final decision, the authors show that some 2/3 of employees do opt for the lump sum distribution. Overall, this research shows that workers are not well informed about their pensions, and also that the provision of information and knowledge can shape workers' behavior. Another way in which pension accruals are utilized includes plan loans, particularly in the U.S. 401k environment. Steve Utkus and Jean Young explore how borrowing from one's DC plan is linked to financial literacy and report that almost 1/5 of 401k participants had loans outstanding at any given time, with the loans averaging 16% of plan balances. The authors also find that lower levels of financial literacy are linked to pension borrowing. That is, those with lower literacy test scores are also more likely to take the loans. A surprising result of the study is that higher-income people are also more likely to borrow from their 401k accounts. In sum, financial literacy is related to pension borrowing, but this behavior should not be viewed in isolation from the household's overall balance sheet. Financial literacy also plays a key role in influencing decision-making regarding stock market investment, as demonstrated in Joanne Jung's study, linking lack of understanding about equity markets and investment in stocks. She employs the American Life Panel, ALP, an internet survey to study stock market behavior. She first shows that avoiding stock investments is not associated with mistaken financial beliefs or other important variables, such as risk aversion and income. She further shows that people tend to shy away from the stock market primarily because they do not understand it. Thus, even if employers design pension plans to default people into portfolios containing equity investments, investors would still benefit from learning about how financial markets work in order to make sensible investment choices. Evaluating financial literacy interventions. It is not surprising that uneducated consumers fail to make good choices when faced with complex decisions, risk, and lengthy time horizons, and there is at least the chance that financial literacy can help inform the decision process. Accordingly, the volume next covers various methods of assessing how to improve financial literacy. The chapter by Justine Hastings et al. Explores how to present fees and charges in pension choice, focusing on the national mandatory DC scheme in Chile, where workers elect which of 5 pension funds they invest their mandatory contributions in. Using a nationally representative individual-level survey, the researchers examine respondents' financial literacy and link it to how they select among 5 fund managers available to handle their retirement investments. People respond that the top 3 factors they use in choosing a fund are recommendations from a friend, fund profitability, and to help a salesman, perhaps because the salesman would in turn do a favor for or provide some sort of gift to the participant. The empirical analysis shows that better educated and higher income respondents are more likely to select fund managers generating highest returns. This group is also more likely than others to turn to their employers for recommendations on fund managers. Lower income respondents rely more on advertising and recommendations from friends. This suggests that the less educated are more susceptible to how information is framed, implying that it may be important to monitor information and plan design as a protective measure for the least literate. To the extent that people can hire advisors, they may not need to have financial information themselves. Nevertheless, many are confused about where to find it and whom to trust to deliver it. This is the topic of the chapter by Angela Hung et al., who study investor knowledge and experience with advisors and broker-dealers. In the United States, broker-dealers and investment advisors have distinctly different roles. Brokers conduct security transactions. Dealers buy and sell securities for others. Investment advisors provide financial planning services and advice regarding securities, and consultants simply provide advice. However, in practice, the lines may blur. So to gain a better sense of how well consumers understand these distinctions, the researchers surveyed members of the ALP and, in addition, conducted focus groups. They show that many people seem to understand how broker-dealers and investment advisors differ, but few can distinguish between financial advisors and financial consultants. Furthermore, people who have worked with financial professionals tend to have long-term relationships with them involving trust. Nevertheless, many believe they cannot use these services due to insufficient assets. A key challenge for the financial industry is to find ways to provide unbiased, experienced, and high-quality investment advice for low cost, and to serve people with widely varying financial situations and needs. A more detailed examination of how individuals with limited assets use the financial system is the subject of the study by Susan Carter et al. In some subpopulations, alternative financial providers play a key role, including payday loan offices and pawn shops, offering much-needed cash but often at a heavy price. Those who use these financing sources take out small and short-term loans, typically about $300 for a term of 2 weeks, carrying very high rates. To better understand payday loans, The authors compare credit union members having an electronic debit charge to a payday lender versus other credit union members. Unexpectedly, those taking out payday loans had higher credit scores, higher inferred income, and smaller loan amounts than did their counterparts. Also, these borrowers had higher initial account balances relative to others, and half could have used their checking or saving accounts or cheaper lines of credit instead of the more expensive payday loans. These findings show that it is important to examine all the financial pathways that influence long-term financial security. Another risk to which consumers are exposed is the possibility that they may outlive their retirement wealth, and this, too, may be related to financial literacy. The study by Julie Agnew and Lisa Seichman explores why many workers seem reluctant to annuitize their retirement wealth, even when relatively low-cost annuities provide much-needed protection against longevity risk. In an experimental setting, the researchers first administer a short test to participants to assess their financial literacy levels. Next, participants play a game simulating investment versus annuitization decisions that might unfold for someone leading up to and through retirement. The experiment is structured to make the annuity choice simple, permitting the comparison of participant financial literacy to self-reported levels of cognitive and emotional overload, confidence, and satisfaction. The analysts find that individuals with higher levels of financial literacy are more likely to pick the investment option, while those reporting emotional overload tend to select the annuity. One implication is that plan sponsors would do well to simplify decisions about retirement plans if they are concerned about helping to protect against retirement insecurity. As in the case of Chile, it is important to evaluate how a retirement scheme might unwittingly drive participants into a path of least resistance that is contrary to their best interests, particularly in the case of the less financially literate. Financial illiteracy can be costly not only to individuals, but also to society, which suggests that programs could be designed to help consumers and plan providers better achieve retirement security goals. This topic is taken up by Sumit Agarwal et al. In their exploration of how counseling can influence mortgage demand patterns. The authors examined two programs, a mandatory 2-hour review of mortgage offers in Chicago and a voluntary 2-year counseling program in Indiana. In the former case, the state of Illinois required borrowers in 10 zip codes to submit mortgage offers for review by HUD, Department of Housing and Urban Development certified counselors, over a 4-month period. Borrowers electing risky mortgage products or who had a low credit score were required to attend counseling. The researchers show that to avoid counseling, small lenders with loose lending criteria and consumers with low borrowing capability dropped out of the market. Other potential borrowers chose less risky products so as to avoid the counseling requirement. In other words, it appears that the program may have achieved its goals without actually providing the counseling. Under the latter voluntary program, participants could learn about credit and budgeting, develop a financial plan, and meet with counselors one-on-one each month. If they remained on track with their financial plan, they were entitled to receive loans from partner lenders. In this second case, the evidence suggests that loans made to program graduates performed much better than those of a control group. Nevertheless, there remain questions of causality about the second example, as those who participated may have also been more likely to be particularly motivated to succeed in the program. Shaping the financial literacy environment. Understanding retirement savings shortfalls may also be due, in part, to problems with time perception, as discussed by Gal Zalberman and B.Q. Kim. Their work suggests that people often tend to weigh the present more heavily than the future, even when they know their short-term decisions will interfere with important long-term goals, such as saving for retirement. The authors characterize this psychological pattern with the term resource slack, defined as the notion that one's preference for something today versus sometime in the future depends on the amount of resources available now versus later. The researchers point out that time is often viewed in economic models as a limited resource, but in experimental settings, people claim they will have more time in the future than they actually do, which helps explain why they put off tasks, such as retirement saving, today. A related finding, playing into the apparent disconnect in the ability to save now for future benefits, is a lack of understanding about time itself. The authors argue that people perceive time as being expansive in the present, but it is telescoped in the future. Thus, if retirement is 20, 30, or 40 years away, it all seems equally far away, as the future is compressed. In addition to believing that they have more time to save in the future than they actually do, people think they will have more money in the future than they do now, which further prompts them to put off saving for retirement. More generally, much psychological research shows that people often fail to grasp the linear nature of time, and hence develop hyperbolic rates of future discounting. One way to reduce the effect of time misperception on retirement saving is to design programs based on pre-commitment. Accordingly, some have tried to tie retirement saving to the annual tax filing process, so as to make saving automatic. This in turn prompts discussion of whether it is better to use behavioral approaches to encourage saving, for example by defaulting workers into pensions, or whether it is preferable to construct mandates that require people to adequately fund their own retirement. This is a theme which runs throughout the volume, emerging in several of the chapters. An intriguing prize-based model designed to encourage retirement saving is the focus of work by Melissa Kearney et al., who illustrate how a lottery-like system can harness the popularity of low-probability, high-reward schemes to build retirement saving. The approach has been demonstrated to appeal to those favoring low odds to big win, including on their retirement saving, while preserving initial capital. For instance, the so-called Million Adventure Bonds were sold in the United Kingdom to finance war debt in the 1690s, with exactly this structure. Again, after World War II, the United Kingdom launched prize-based premium bonds with the slogan, "Savings with a Thrill." This program today has more than 20 million bondholders. Similarly, in South Africa, a privately run plan, sponsored by the First National Bank and called the Million a Month Account Plan, enjoyed a take-up rate higher than any other bank product. The authors helped initiate a prize-based saving program operated by a U.S. credit union called the Save to Win. This program attracted many participants before it was closed down by authorities, who viewed it as competition to the state lottery. Nevertheless, this initiative provides insight about how to engage certain segments of the population who are hard to reach by traditional saving programs. We also seek to expand understanding about financial literacy efforts underway around the world. In the case of New Zealand, Diana Crossan described the work the Retirement Commission has done to design a national strategy for financial literacy, along with numerous private sector and non-government partnerships. Specifically, the national strategy to improve retirement readiness involved working with banks and other organizations to help assess needs and develop programs to improve financial literacy and retirement saving adequacy. A key role is assigned to a well-designed and informative website for all citizens, young and old. To date, over one-third of the country's population has consulted and used calculators on the national website. In addition, the author highlights how the government integrated financial education in schools and in tertiary educational institutions. In addition, non-governmental organizations are also taking on an increasingly salient role around the world to improve financial literacy in poor populations. Robert Holtzman from the World Bank correctly advocates for programs to be tailored to meet the attributes of low- and middle-income countries, rather than exporting lessons from developed nations. For instance, many people in low-income countries lack access to basic financial services, and day-to-day needs become priorities rather than long-term planning. The rural nature of poor countries is also an important factor inasmuch as, in these nations, assets are likely to be seeds or cattle, rather than homes or investment accounts.
Sample complete. Ready to continue?